Have you heard of the SALT deduction? It stands for state and local tax, and it only applies if you itemize your tax deductions, not if you take the standard deduction. I'm Mark Steber, Jackson Hewitt's Chief Tax Officer, and today we're going to talk about what the SALT deduction is and how it has changed in 2025. Here's the deal. Most people take the standard deduction, but every taxpayer has the option to also itemize their deductions instead. It's seriously worth considering itemizing for those who have deductible expenses that total more than the standard deduction. The standard deduction in tax year 2025 for the different filing statuses are as follows. Single, $15,750. Head of household, $23,625. And married filing jointly, $31,500. So think about whether you have deductible expenses greater than the standard deduction when added up together. Prime examples of deductions include mortgage interest, state and local taxes or SALT, significant medical expenses, disaster losses, and large charitable donations. What can be deducted with SALT? Well, the SALT deduction allows some taxpayers to deduct from their federally taxable income certain state and local taxes they have paid throughout the year. With the SALT deduction, you can write off a few of these. State and local income taxes. W-2 employees can deduct the state and local income tax withheld from their paycheck throughout the year. Self-employed taxpayers can deduct the estimated state and local tax payments they've made throughout the year. Sales taxes. Keep track of how much you've actually spent on sales tax and save those receipts. Property tax. If you pay annual tax on your personal property, like a vehicle, a boat, or your home, you may be able to write off all or part of your property taxes as the SALT deduction. The Tax Cut and Jobs Act, which became law in December 2017, limited the SALT cap to $5,000 for a married person filing a separate return and $10,000 for all other tax filers. But the bill passed back in July 2025 increased the SALT cap to $40,000 or $20,000 for married filing separately for 2025. And $40,400 or $20,200 if married filing separately for 2026. For tax years beginning after 2026 and before 2030, the cap will be increased about 1% per year. For tax years beginning in 2030, the cap will revert back to $10,000 or $5,000 for the married filing separately. The increased SALT cap is also subject to a phase down once your modified adjusted gross income exceeds $500,000 for 2025 or $505,000 for 2026. After 2025, the threshold increases by 1%. Taxpayers who are fully phased down will be limited to the old $10,000 for their SALT deduction. What is not deductible under the SALT deduction? Well, according to irs.gov, there are a few things not covered by the SALT deduction, including but not limited to federal income taxes, Social Security taxes, transfer taxes, such as taxes imposed on the sale of property, stamp taxes, homeowners association fees, estate and inheritance taxes, service charges for water, sewer, or trash collection. Have questions about the SALT deduction or need help figuring out if you should consider itemized instead of taking the standard deduction? Well, schedule an appointment with a tax pro today at jacksonhewitt.com.